Are you thinking about investing in real estate? Well, taxes can be confusing, but they don't have to be. In this video, I'll break down the top 5 questions that every new real estate investor asks, plus a bonus tip at the end that can save you tens, if not hundreds of thousands of dollars in taxes, so stick around so you don't miss it. Hi, my name is Thomas Castelli, and I help high-income earners, business owners, and real estate investors like you legally reduce your tax bills by using the tax code to your advantage. Before we dive right in, make sure to hit that like button and subscribe to the channel so you don't miss out on future tax-saving strategies. And for even more exclusive tips, join our free newsletter. The link is in the description to this video. And if you have questions at any time throughout the video, go ahead and drop them in the comments and I'll respond with an answer. Question number 1, do you need an LLC to invest in real estate? Well, the short answer is no, you do not need an LLC to invest in real estate or take tax deductions. You could buy a rental property in your personal name. However, LLCs can provide legal protection, so it is worth consulting an attorney to determine the best structure for you. Just avoid putting rental properties into an S corporation because it can cost you big time in taxes down the line. If you want more details on why, check out my other videos on this topic. Question number 2. What is depreciation? So the IRS lets real estate investors depreciate the cost of their property, excluding land, over 27.5 years for residential and 39 years for commercial properties. The best part, depreciation is a non-cash expense, meaning you can show a loss for tax purposes even when your property is generating positive cash flow. In short, you're legally telling the IRS you lost money while actually making money, and yes, depreciation is required by the IRS, so you make sure that you use it. Question 3, can I use real estate losses to offset my W-2 income? And that depends. Rental losses are typically passive and can offset your W-2 income unless you qualify for one of these 3 exceptions. The first is going to be the special loss allowance, which allows you to deduct up to $25,000 in rental losses if your income is below $100,000. The second is going to be the real estate professional status, which turns rental losses from your midterm and long-term rentals non-passive. The third is going to be investing in short-term rentals, and losses from short-term rentals can be non-passive if your property has an average period of customer use of 7 days or less and you materially participate. Question 4, what deductions can I claim as a real estate investor? Well, there's a lot of deductions you could potentially claim, but here's some key ones you're not going to want to miss out on. That's mortgage interest, property taxes, depreciation, which is a big one. Make sure you don't miss that. The repairs and maintenance, property management fees, insurance, legal and professional fees, and travel expenses related to your property management. These deductions can significantly reduce your taxable income, so use them wisely. Question 5, do I have to pay self-employment taxes on my rental income? And the answer to that is no, you generally do not have to pay self-employment taxes on rental income, even if you qualify as a real estate professional or invest in short-term rentals. But there is an exception. You would have to pay self-employment taxes if you operate a short-term rental and provide quote-unquote substantial services, which are hotel-like services that you would find in a hotel. Otherwise, rental income is passive and not subject to the self-employment tax. Now for the bonus question. How do real estate investors pay $0 in taxes? Well, this is a common question and we get it a lot, and some gurus do exaggerate, but it is possible to pay little to no taxes by using the following strategies. First, use depreciation to offset rental income, and boom, you're not paying any taxes on the cash flow from your rental properties. Next, qualify for the real estate professional status or use the short-term rental loophole to offset your W-2 or your active business income. Next, refinance or use a HELOC instead of selling your property to tap into equity because loan proceeds are tax-free. And when you do have to sell a property, use a 1031 exchange to defer the capital gains taxes by reinvesting the sales proceeds into the next property. And lastly, pass your properties to your heirs using a step-up in basis to wipe out capital gains. Remember, smart investors don't just make money, they keep more of it by using these strategies. There you have it. These are the top questions I get from new real estate investors. Did I miss any? Drop your questions in the comments and I'll personally get back to you with an answer. If you're serious about maximizing your tax savings and avoiding costly mistakes, why go through this all alone and all the trial and error? Our team of real estate tax experts can help you fast track your success. Book a free 30-minute discovery session by using the link in the description. That's it for now, and I'll see you in the next video.